Good evening and welcome to another Be Informed session. My name is Karl Hariwala and I founded Be Informed to help people make informed decisions. Today we'll be looking at Australian tax returns. It's very timely to consider tips and traps as the deadline for submitting your individual tax return, if you don't have a tax agent, approaches in a few months' time. Today we are joined by Roger Fredrick of Trident Financial Group, who will be sharing his top 5 tips when preparing your FY23 tax return in Australia. Before we proceed further, I'd like to acknowledge the traditional owners of the lands on which we're meeting today and pay my respects to their elders, past and present. Today's session is being recorded, and if you do happen to need to leave early for whatever reason, don't worry, because it will be uploaded straight to our YouTube channel where you can watch the entire session at your convenience. Today's session is based on Australian taxation principles and is in general information only. So if you do have any specific queries about your personal circumstances, please do consult with a professional, because some of the tips and traps presented to you today may or may not be applicable to you. In relation to the currency of information, the information is current as of this month. So if you do want to rely on this information in the future, please do check with a professional, as the nature of that information may change. So with that in mind, I just want to remind everyone that in terms of Q&A, there'll be a Q&A session following Roger's seminar, which should probably conclude around 6:30. And if you have any questions, feel free to raise them through the chat function straight to me, and then I'll relay them through to Roger for his consideration. And Roger's also kindly prepared a one-page handout, which will be emailed through to registered participants following today's session. So with all that in mind, Roger, I'll hand over to you, and you can take us through your seminar.
Fantastic. Thanks, Carl, and thanks for those that are attending. Clearly, you're quite diligent in trying to get on top of your tax affairs and learn about how best to lodge it to get the most return back, which is excellent. So I might just quickly introduce myself. So I'm a registered tax agent. I'm a chartered accountant, and I started my career back in Deloitte days almost over 12 years ago. So just to give you some context about our firm, we lodged almost 5,000 tax returns last year. So I think we're quite well versed in what's required to lodge a tax return, and we lodge obviously various different types, from individual tax returns, companies, trusts, etc. So, but today's focus will be the top 5 tips when preparing your FY23 tax return in Australia. So as you may have heard, there's constantly changes happening with Australian tax legislation, almost on a monthly basis, and as tax agents, we're required to stay up to date, and we have training on a weekly basis to cover off on all of the changes. So as Carl mentioned, this is the information that's current enough to date as at today. Let's get into it. I've got 25 minutes, and I want to make sure that there's plenty of time to answer any specific questions that you may have. So we might start off with tip 1. So as tax agents, when they're looking at people's tax affairs, whether it's individual or business, you've sort of got two distinctive types of people. You've got the type of people that are organised, they have the information available on hand as requested when needed, and then you've got the other people that try and scramble to get all that information together. So as you can appreciate, those that are organised generally get larger deductions because they've got more details that they've kept records of that we can then use. So one of the key things is, like, there are lots of different ways in which you can get organised, but what you need to think about is what is convenient and something that you can stick to personally. So what I've listed are some of the common methods that people get organised when, keeping a track of all of their records. Some people, they love the Excel. So they keep a running track record year on year. They've got a tab at the bottom of the Excel sheet or a new worksheet for each financial year. They copy and paste the same template year on year, because if you can appreciate, once you enter the workforce, you will be required to lodge a tax return for the rest of your life. As long as you earn assessable income, you're required to lodge it. So I encourage everyone to get started early in creating your own personal system in what works for you. So Microsoft Excel is a really, really common one that we see. my wife as well uses Microsoft Excel to keep a track of all of her year-on-year deductions, so she can go back and look at her history. Another one for those of us that are more cloud-based and cloud-inclined is to use something like a Google Sheets. That's just another simple way, or even your Apple equivalent, just to keep a running track record of your deductions. If you're the type of person that likes to take notes, there's a lot of different note apps you can also do. So simply create a new note, 2020, say 4 tax deductions, and then as and when you start incurring expenses and deductions, you can take photos, you can insert it into your note-taking app, whether it's Microsoft OneNote, Evernote, Notability, or Apple Notes. Any one of those are fine. So come tax time, you have all of that ready to go and accessible, because your accountant or even yourself, you need to sort of have that readily accessible if the ATO ever requests that supporting documentation. Another tool that the ATO has put out a few years back now, and they've refined it over the years to make it more user-friendly, is the ATO My Deductions app. You can find it on Google, on the Google or the Apple Store. And that's something as well. That's something that you can also use. I think I personally don't use that. I think I tried playing around with it. What it does, it tries to, I think, pre-fill some of the information straight into your MyGov tax return. But this is the one that I use, which is the very last dot point. I use the email, and all I simply do, because a deduction happens often at an unplanned time when you're buying something that has a connection to your work, that you can claim. So I just simply take a photo of it on my phone, and I simply email it to my personal email, and I simply type in at the start the financial year tax deduction. So it might be, say, I incur something now, it'll be 2024 tax deduction dash and the name of the deduction. So when I go at the end of the financial year and I'm looking for all of my receipts and all of my deductions, I just go to my Gmail and I just type in 2024 tax deductions, and all of the tax deductions that I've emailed myself is there. And the thing with those cloud-based email providers, such as the free to use ones like Gmail's, I've got records from 2010, 15 years back, because they generally sit there because you have a large amount of storage space. And as long as you index it correctly, I know what to search for by using the subject line. If you have that same system every single year, so 2023, 2024, 2025, it's very easy to go back. So if you're ever reviewed or audited by the ATO, it's very easy to go back and pull out the record. So dealing with the ATO on a almost daily basis, one of the things that helps demonstrate professional competence or due care as a taxpayer or even as a tax agent is the ability to rapidly respond when there is a question. So if the ATO does call you and say, hey, we are reviewing your tax deductions that you put in, are you able to provide information regarding to X? The faster you can respond to that, the faster it gives the confidence to the ATO officer that this person has the adequate evidence, the relevant evidence, and it matches what's in the tax return, and we're satisfied, and the faster they can close the case file. Because one of the things the ATO officers hate doing, and they're also benchmarked and KPI'd on, is how quickly they can close an open case. All right, just like any other organisation, even the ATO officers have got their own KPIs. So if you can stay organised, it will put you in very good stead to bat off the ATO if they ever do come knocking. So that's tip number 1. So maybe let's go to tip number 2. Alrighty. So tip number 2 is collate proof, which is your evidence. So when it comes to a tax deduction, the key word that is often used from a legislation perspective is the word nexus. Is nexus, which means connection. Is there a connection to the expense or the deduction that you're claiming to your ability to earn assessable income? So whatever profession that you're in, there are certain professions where the employer pays for and substantially covers all of the costs in doing work. So all you really need to do is turn up. And, a simple example would be, my very first job when I was at Hungry Jack's, all I had to do was turn up. I was given a uniform. I didn't have to do any work at home. And there was no other expenses that I incurred other than perhaps some protective shoe wear, which is deductible because I need to buy, steel cap boots for work, and things like laundry expenses because it's dedicated work clothes that I can launder. But substantially, most employers do provide the employees with everything that they need, those that are from a blue collar background. But those of us that are from a white collar background, that are knowledge workers or working perhaps in an office type of environment, there's often a lot of areas that are not quite provided by the employer. You know, those, for example, I'm working from home, so I'm using my personal internet for a work-related presentation. So obviously that is a portion of that expense that's deductible. So really, this particular slide here, tip 2, collate the proof. It's around finding what are the proof or receipts or invoices that you can generate when substantiating your declarations. So some of the things that I've noted down there, as you can see, dot points. The most obvious one is your receipts, right? So if you've gone and purchased something for work, say you've gone to Officeworks, if you work in an office environment and you've purchased something, or you've purchased, say, even a mouse for your workstation to work at home. You know, those are examples where you would have received a receipt. And one of the beauties with a lot of those places, such as Officeworks now, you can actually request they email you the receipt, so that can then go back to your system that you've got to start collating that. Invoices, so if, for example, you've got a phone bill and there is a work-related use percentage, that usually is emailed to you. So, you know, a way in which you can use tip number 1 is then you can then forward that email to yourself as 2024 deduction dash mobile phone invoice, and then that's another way in which you can use that indexing method within your inbox to find it, or you can simply drag and drop and save it in a folder if you're using something like Dropbox or Google Drive, or even just your normal desktop drive. So the other thing as well that is a point of evidence is emails or messages or letters. So if your employer has said to you, can you go and purchase this for work, or if they've given you a letter saying that you will be required from time to time to travel, or if you complete this course, it will enable you to progress professionally in your career in terms of say professional development. If there's a connection there, the nexus word I was talking about, those are all examples of other evidence that you can use and are strong pieces of evidence. So logbooks are relevant when it comes to things like motor vehicle travel. So depending on if you use a car for work, you can keep a logbook, and also logbooks for working from home as well. So, you know, you can keep that in the form of a diary or in the form of a logbook. You know, photos and videos. Say, for example, you use a portion of your home that's dedicated for work purposes, where you perhaps say renting a place and there's a specialized area within your home that you keep for work purposes, or if you're storing, say, work-related records or documents or something in a dedicated location, you know, having photos and that sort of evidence also helps as well. So contracts and employment agreements are also important. There could be things in there that specify the need to incur certain expenses that your employer won't reimburse you for. Valuations when it comes to, say, the sale of a property. If you were previously living in that property and there was a portion of that property where it had a deductible purpose because you were then renting it out, if you fall outside of the exemptions and you convert a former private residence into an income producing asset, a valuation may be relevant in that scenario from an independent valuer. So that's another form of evidence. Timesheets and rosters are quite valuable. So like you might have a roster and you're rostered to work, say, in another location within a particular day. You might have to travel between locations. So those are all evidences that contribute towards substantiating your deductions. I've got also here logs of time you spent accessing employee systems or online business systems. So if you do log into workplace systems and there are log records, you know, if you can export that, that's another form of evidence, like if it's after hours and you're logging in to do work-related stuff. And also diary or similar document kept contemporaneously. So there's different types of evidence. There's evidence where you are making a record and saying this is a record, a contemporaneous evidence, or there's a substantive evidence such as a receipt or an invoice, which, you know, comes from an independent third-party supplier. That's quite easy to verify and confirm. So those are multiple types of evidence. So the evidence itself doesn't matter as long as it can substantiate the claim, you know. Even if it's just for example, if you use your mobile phone for work, the things that they look at is work-related phone calls versus non-work related phone calls. So it's not duration on the phone, it's actually the number of calls. So if you know, me personally, I'm not the type of individual that I pick up the phone and spend a lot of time talking to my friends and things like that. You know, we do text messages and things like that on WhatsApp and what have you. So if you are spending a lot of time on the phone talking to clients during the day, and you know there is only a small percentage of phone calls that are private, perhaps to your family members or your friends on the odd occasion, you know, by you actually taking an invoice from that shows you call records and highlighting those that are work related, or if it's easy to do the personal ones, that way you can see the majority being work related. That's another example of how you can sort of keep your records as well. So that's sort of tip number 2. It's make sure you collate your proof and evidence when it comes to preparing your tax return. So document it in some form of a repository where you can capture it, and then come tax time to actually put your information together, collate all of that stuff together, so that way you have it in one place. So let's go to tip number 3. Excellent. Okay, so I often refer to tip number 3 as know your Ds, or your deductions, because within a tax return you have your income labels and you have your deduction labels. So in short, I call them your Ds, know your Ds. So there are actually 15 deduction labels, but the most common ones are the 10 that you see on the screen. You know, I call them D1 to D10 because that's how they're labeled. And this, I might spend a little bit of time on this because I don't know what your individual circumstances are, but I might just briefly spend so that way I can deposit some information for you when you do prepare your tax return. So the first one is work-related car expenses. So there are 2 distinctive methods in how you can claim something that is a work-related car expense. So there's the logbook method or the cents per kilometre method. So the cents per kilometre method is one where you aren't required to retain any receipts. You simply have to retain a record of all your work-related travel, and you can claim up to 5,000 kilometres using the cents per kilometre method. So that the rate per kilometre changes year on year, and I just had that open a moment ago just to quickly let everyone know what the latest rates are. If you just bear with me for one moment, here we go. So the 2023 financial year, it's 78 cents, and that's an increase from 72 from the previous year. And then the year that we're in, which is the 2024 financial year, the rate is 85 cents per kilometre. So if ever in doubt, there is a lot of information on the ATO website where you can actually access a lot of this yourself. But there is a bit of a trap, though, if you're not careful, that you may read something and assume something, but it might not be the full picture, because legislation often comes out and the ATO website doesn't always get updated the same time legislation comes out. So that's a trap, but most of the information between your D1 to D10 is quite widely documented and usually updated in relatively short order, so that way you do have the current information. So as I said, there's the cents per kilometre and the logbook method. So you can claim up to 5,000 Ks, which gives you a pretty healthy deduction, and for most people, that's actually one of the largest tax deductions that you see in their tax return. But however, if you do have a high percentage of work-related travel, I do highly recommend you use the logbook method. So what the logbook method is, in summary, is you simply compile all of your expenses in running your motor vehicle, and you times it by your work use percentage by using a logbook. So the requirement to keep a logbook, you have to keep a 12-week logbook, which is indicative of a typical work-related travel schedule. And in that 12 weeks, you'll have obviously a combination of opening kilometres, closing kilometres, and whether it's a work-related trip or a private trip. So you simply collect this logbook. It can be done, you know, on a piece of paper. It can be done on an Excel spreadsheet. You can download or even actually go and buy some logbooks. So all you have to do is keep a 12-week logbook, which is valid for 5 years, provided that you don't move or you don't change roles and your circumstances don't substantially change. So me as an accountant, you know, here's a quick tip. During my busiest period, if I keep a logbook, you know, hopefully that's somewhat representative of my usual period, because we do travel a lot to see clients. That period for 12 weeks, let's just say there's 80% of that travel is work related, then I can then take all of the expenses, and typically it costs somewhere between $12,000 to $18,000 to run a motor vehicle. So if you add up all of the fuel, if you add up the cost of servicing it, the registration costs, the insurance costs, and also the depreciation, which is usually quite a large number because most cars are, you know, multiple tens of thousands of dollars normally. If you add all of that and you apply a percentage against that, generally you get a higher tax deduction than your cents per kilometre. But you need to be able to substantiate that you are travelling for work. And I want to note one distinction. Travelling to and from your primary place of work is considered private. So for me, if I just go from where I live to the office, that's private travel. But if I go from the office to go see a client, if I go from the office to see a partner, or if I'm going and doing a presentation, or if I'm going to a networking event, all of that is work-related travel. But to and from the office is generally private. So I just want to note that distinction. A lot of people get confused on that one. So those are the two methods for work-related car expenses. So depending on your industry, if you do travel to other locations, that might be relevant to use the logbook method. Or if you want to keep it simple and you don't want to have too many records, like you might know that you go from one job site to another job site every week, and it's X amount of kilometers between job sites after you go to work, then that might be an easier way to simply use a cents per kilometer method. Okay. So D number 2, which is work-related travel expenses. So think about things like tolls, think about things like parking. But the key distinction here is expenses that you incur out of pocket that you are not reimbursed for. So if you submit your receipts to your employer and you're being reimbursed for it, you don't get the opportunity to double dip. So get the money back and then claim a tax deduction. So keep a record of those. And sometimes those expenses, other than tolls, which sits on a toll account, which is easy to access, but things like parking are often a paper receipt. So again, take a photo of it, snap it, and get it in an email or get it into your Dropbox or something along those lines. So those are types of work-related travel expenses. So D number 3, which is work-related clothing, laundry, and dry cleaning expenses. So that's relevant generally for those of us that work in a profession where we're given a uniform. So someone like myself, where I wear a suit, although it's somewhat of an expectation for me to wear a suit to go to work as an accountant, I can't claim any dry cleaning or expenses to purchase this as a tax deduction because it is readily available and to be used for private use. So if it had a logo all over it and it was provided to me by my employer, laundering it and maintaining it and things like that, I can certainly claim. But if it's something that's private, so a lot of, say, for example, if you work in retail, a lot of retail shops will require you to wear the clothing or the footwear of that particular shop. But unfortunately, you can't claim a tax deduction, which is interesting because you can readily use that for private use. So generally, those of us that work in professions that have uniform and using your hands and using tools, etc., there are a lot of work-related clothing, laundry, and dry cleaning expenses. The other thing with work-related clothing, think of things like protective clothing. Think of things like, say, special comfort shoes. So if you're a nurse and you have like shoes with extra cushioning that's specific for work, those are the type of deductions that you can claim in that space. And there is no limit as long as it can be substantiated, but up until $150, you don't need a receipt to substantiate it. But one of the things that the ATO does is they do a lot of data matching. So they look at your industry profession code. So, in your tax return, you will have to put in what do you work as, and then they look at the sample size of everybody else that's in Australia that has that industry profession code. And if your claim is higher or lower, if it's lower, it's fine. But if it's higher, or if it's unusual for that industry code to have a claim, then you are at risk of being reviewed. It's okay. It's not a bad thing to have a claim just because somebody else doesn't, but be prepared to have something ready to be able to provide. Okay. All right, let's go to D number 4, work-related self-education expenses. So there's a key distinction with this particular one. So many of us may have gone to university. Some of us may not have. Some of us may have done some other courses before getting gainful employment. Costs that you incur prior to getting gainful employment is not tax deductible. But costs that you incur to increase your income capacity when you are in gainful employment is generally, if there's a nexus and you can have the evidence to demonstrate, such as, say, the employer says, if you do this course, it'll help you become a senior accountant. If you're studying a CPA or a CA, and you incur those costs out of pocket, those are the sort of deductions that are tax deductible. So what's different in this financial year is previously there was a $250 limit, $250 amount, anything above $250 you could claim, but now they've removed that. So other costs that are in here are things like textbooks, things like any other any other expenses that you incur, maybe library costs or something like that. If you need to access a specific library that has a cost, that contributes towards your self-education and progression to earn assessable income. So that's something that you can claim in D4. So those of us where I've seen big deductions come here is many of us that want to say progress and do an MBA, for example. I see some big deductions coming out of the D4 for the MBA cost when it's incurred out of pocket without any reimbursement. Okay, D5. This is the next biggest one, usually after car expenses. Actually, can I just do a quick time check? I'm just conscious of time. Carl, how are we going for time?
That's okay, Roger. Keep going. You're going fine.
When do I need to go until? Just so I'm clear.
Oh no, it's until 6:30, but we can go over. That's fine because you can just chip into Q&A. That's all right.
Yeah, perfect. Okay, so yeah, the other key one, other work-related expenses. So this is one during COVID. A lot of people claim their work from home expenses. This is where you can claim internet, your mobile phone, your depreciation on any assets that you purchase. Like say, for example, I've got a sit-stand desk at home. I invested a little bit in this one. I've paid about $700 from Officeworks to get this because it's quite solid and heavy duty. So this is the sort of things that you would expect to see in D5. Generally, any assets that you buy that's greater than $300, like let's just say you buy your iPhone up front, you can't claim all of it up front. You have to depreciate it over its useful life. So you might see that in D5. So D5 is another big one where a lot of people put their deductions in because it's sort of the other miscellaneous that doesn't fit into car or clothing or study, sits into D5. So the most common deductions for most people is 1 through to 5. Okay, so D6 is not as common and not as commonly used. This is where you pull assets that are under $1,000, and then you can claim, I think, 37.5% in year one, and then the tax return automatically calculates how it's deducted. So it basically pulls your assets together. So you might spend, $800, say, on my desk, for example. I could stick that in D6, or I could stick it in D5 as well. D7, interest deductions. All right. So if you have borrowings to generate assessable income, generally you would see this in interest deductions. So this might be like margin loan interest might sit in here, and things to that effect, where you've borrowed some money to purchase something for work-related, or borrow some money to invest in something. Okay. Dividend deductions. So if you borrow to invest in shares that generate dividends, you might see that in D8. And D9 is another common one. So throughout the year, a lot of us, were approached when we're at shopping centres, around in the street, or even from friends or family that are, participating in some sort of charitable activity. You'll see D9, where they'll go, hey, can you support me here? Can you sponsor me here? So I know most people, when they do it out of free will, out of their heart, because they want to support the cause. But this is an opportunity for you to get something back for your support, which is a tax deduction. But the key here and the distinction here is it has to be to a deductible gift recipient. So if you're simply, giving someone some money because you want to help them with something, it is a donation technically from you, but it's not to a deductible gift recipient. So if you go to the ABN lookup website, generally you'll get, if you can get a receipt for what you've donated for, you'll be able to see whether they're a deductible gift recipient. So think things like Cancer Council, World Vision, Oxfam. Those are the type of charities and organisations where you can stick it in D9. And if you do use a tax agent to prepare your tax return, their fees are also tax deductible, because the reason you're incurring that cost is in the course of getting the tax advice to prepare your tax affairs. So D10, that's where you'd stick it. So I won't spend much time from D11 to D15. There are a lot of miscellaneous type of deductions. They're not mostly relevant, other than D12. So if you make a personal super contribution, so you received your income, and then you want to claim a tax deduction for additional money that you put into super, you can fill in a form that's called a notice of intention to claim a deduction, usually with your super fund, or if you have a self-managed super fund, you can fill it in and give it to yourself. And then what happens is you can then claim a tax deduction for any of those super contributions, and that sits under D12. That's the only other one that I wanted to talk about between 11 and 15, because a lot of them are not commonly used. Very rarely do I see them used other than D12. So those are the Ds. So my tip here is, when you do prepare, say, your spreadsheet or your Excel thing, if you're in a particular profession, there are particular deductions that you claim every single year. So you don't need to reinvent the wheel. Just open up that spreadsheet, put D1 through to D10, and then put at the top column 2023, 2024, 2025, and it's easy to see what did I claim last year, what am I claiming this year, and the total at the bottom, which is the total deduction, should be hopefully what's in your tax return, and it's easy to sort of keep track of that on a year-on-year basis. I've got clients that do that on Google Drive, and they just simply send me the link, which makes my life a lot easier. All right, let's move on to tip number 4. Okay, so just because I claimed it last year doesn't mean I can claim it this year. That's one key takeaway that I want all the participants to take note of, because things do change from time to time. So a perfect example is working from home expenses. So obviously COVID hit and impacted many professions. So as a result of that, many people work from home during COVID period for extended periods of time. So there's a lot of work from home related deductions. So it got to the point where people came out of COVID, but many people were still claiming very high deductions incorrectly for working from home. So as a result, some of the work from home deductions has changed in how you can claim that and the records you need to keep, right? So that's an example of something that's changed. So do your own research, consider the ATO website. Often when these substantial changes do come through, you'll hear about it in the media, because you know a significant portion of the tax take in Australia is from individual income tax payers. So you'll hear about it in the media. You'll hear it on Channel 9. You'll hear the on all the popular media outlets. So if you do hear something, I would highly recommend you go and try and find a reference on the ATO website, or find as like a proper reference, not just a media article, and then use that as a basis to what you do and don't claim. But like I said in this slide, you can see it can be risky, it can be misled. And you may misunderstand what the changes are as well if you're not clear on how legislation reads, etc. So one of the other substantial changes is the government did not continue the low and middle income tax offset beyond 30 June 2022. So during COVID, a low and middle income tax offset was implemented where you could get an extra $1,500 if you earned a particular amount of income. They removed that. So straight away, this financial year, the 2023, which what I'm referring to, a lot of people, their like-for-like tax return is $1,500 worse off. Okay, so it's an example of a change. There are ATO industry-specific guides. So if you are a tradesman, if you are a nurse, if you're a defence force personnel, there are a number of industry-specific guides. So if you simply go onto Google even and type in ATO industry-specific guides, you'll be able to go into a link and see if there is something there that's relevant to you. And that's a quick little tip. And the reason ATO puts that out is because there are a lot of people within that profession. They know what the common deductions are, so you can go and get a head start by looking over there. If you are a tax nerd, or if you are inclined to want to read legislation, which we do, and it's not as fun for most people, you can also do that. But just be careful that you may not fully appreciate what is being communicated and what is being legislated. So my final point, which is speak to a tax professional if you need help. I often get clients that go, "Oh, Rog, can you do my tax return?" And I'll ask them what do they do, and I'll learn a little bit about them, and I'll often encourage them to do their own tax return. I know I'm turning away revenue, but I'm perfectly fine with that, because at some point, before my personal tax affairs became complicated and I didn't know what I was doing my own tax return. It was perfectly fine. It's generally a low risk, but as your investments, as your tax affairs change and develop, you may want to speak to a tax professional. And yes, they will charge you to do the work, and fees are going up with inflation. But often, from my experience, you are much better off when you speak to a tax professional, because they know what questions to ask you to try and extract the deductions out of your head, because you may not think about something that they can ask you to extract that from your head. I'll give you a perfect example. I had a client come across. She was a IVF nurse. She put together a tax return and she had to pay money. Anyway, so she came to me through a referral, and then I asked her a heap of questions. And what I found out during COVID, she was actually traveling to Bendigo, staying in Bendigo for 2 days a week in one of the remote clinics, seeing patients over there, and traveling back to Melbourne. So there was a lot of travel expenses that she was able to claim. And while she was in Melbourne, the guidance came out, if you can work from home, you should work from home. So she did work from home as well. So there's a lot of work from home expenses that she had never claimed as a nurse, an IVF nurse in the past, because she did a lot of remote consultations via Zoom. And so we got her from having to pay to a $3,000 tax refund. So that's the power of working with a tax agent that is suitably qualified. So that's tip number 4. Let's go on to the final tip number 5. All right. So this one's a really simple one. So the ATO actually keep records of your conduct as a taxpayer. You know, are you lodging on time? Are you paying if you have any outstanding payments on time? And at the end of the day, the ATO and the way our system works here in Australia is a self-reporting system. So you are responsible for what goes into your tax return. Even if a tax agent prepares it for you, you are still somewhat ultimately responsible. So what I encourage everyone to do is lodge on time and do it early. So if you're not lodging through a tax agent, your deadline is 31st of October. So there's still a little bit of time. So get in, lodge it early, get it out of the way, tick that admin, off your list, right? Check your ATO mail as well. So on MyGov, you can, obviously go in and you can have a look at any communications you received from the ATO. Sometimes you'll get an alert in your email saying you have a message in your MyGov, which is a very annoying alert. I'd rather them just send it to me by email, but you have to log in, 2-factor authentication, and check what is being communicated. Don't ignore it. You know, there could be something in there that could be quite sensitive for you, time sensitive even for you to action. Keep your records up to date, your emails, your contact numbers, and your addresses. If there is ever a dispute with the ATO, they will often rely on records. And because the ATO has quite a substantial data sharing and data matching program, they can access a lot of records that you don't even realize. They can access like your motor vehicle registrations. They can access the electoral roll. They can access the immigration data and the passenger card information and what you write when you're traveling in and out of Australia. They can access utility providers. So if you say, that was I was living there and occupying it, if you're trying to claim the primary place of residence exemption, but you weren't really there, they can see whether a reasonable person's utility usage was used while you're claiming that you're there. So make sure you keep all of your records up to date. If you move between houses, update your banking records as well, because there's a lot of information that the ATO can access. And the second last point there is being honest and transparent. I know that, some people push the boundaries, which is my final point. Like, you can push the boundaries, you might be able to get a little bit more. But as long as you understand what the boundaries are that you can and can't cross, there shouldn't be any boundaries that you can cross, but understand what the boundaries are that you can't cross. So within reason, you can obviously, I encourage everybody to maximize their tax return within reason. But try and be as honest and transparent as possible. If it's not really a tax deduction, don't put it in, because at the end of the day, the marginal benefit that you get from a bit more of a refund is probably not worth it if you are reviewed and you have to pay it back, because it's just not a fun feeling to be reviewed and have to pay something back. I've had clients that are reviewed, they push the boundaries, and then they've had to pay something back. So play by the rules. I suppose that's probably my closing message. Play by the rules, seek professional help, and then you'll be in good stead. Thanks.
Thanks, Roger. That was great.
Thanks, Carl.
Very, very thorough seminar. Roger's details are on screen, so if you do wish to have any further queries with him, please do directly reach out, and then he can answer those questions for you. Just a reminder, this session is being recorded, so if you do have to drop off or have somewhere else to be, you can watch the entire session on our YouTube channel following the session. And Roger has kindly prepared a one-page handout, which will definitely be shared with all registered participants, which covers those 5 tips that you went through earlier. So we'll now move into Q&A, and we've got a few questions, Roger, that we've received ahead of schedule. So we can go through those first, and then we can go through the questions that have come with that function. So the first one being, Roger, if it's hypothetical, this person actually has received an audit. If the person does get audited, is it recommended to do it themselves and respond to the queries by the ATO, or should they engage a professional to help them navigate those processes?
It's a great question. It just depends on the nature of the audit. If the nature of the audit is quite simple, they're asking for you to provide some information that you already have on file, and it's not compromising, by all means, you're more than welcome to respond directly. If you think the nature of the audit's quite complex, I would certainly consider engaging a tax professional. I had a client he purchased a Ferrari in his company. The ATO said, and then he sold the Ferrari a few years later, and the ATO said, why haven't you paid fringe benefits tax? That was quite a complex audit. So if you have a Ferrari and you buy it in your company, speak to your accountant.
Yeah. And I guess, yeah, sort of depends, right? And today's seminar, I guess, has touched on individuals' tax return circumstances in relation to, I guess, their day job, or if they're self-employed. It hasn't, of course, considered their property investments, share portfolios, and all the other sort of, different asset classes that you may have exposure to that will require tax, considerations. The next question that we've got is sort of in relation to someone being self-employed. And they, I think you've touched on it in tip 1, which is maintaining a good system. Do you feel that they need to sort of invest in in zero and sort of more sort of I guess robust software and systems, or can they still just maintain something quite simply in an Excel spreadsheet and get through it, I guess, if they're self-employed?
Yeah, good question. So if what you do while you're self-employed is simple in nature, so a lot of a common self-employed person is like an IT contractor. So a lot of people, they might work in a role as a project manager or a business analyst, and then they may decide to go and do that. And when they do that on like what they call a day rate, and they'll simply generate an invoice. So obviously something like a zero is a good standard when it comes to record keeping. It allows you to invoice out of it. You can receive payments in, mark it off from invoices. But if the nature of what you do is quite simple, if you're sending a monthly invoice and you're an IT contractor, so some of your expenses, if you reflect back on my D1 to D10, those are the same type of expenses that you'll be incurring. You might have work-related travel, you might have some work-related working from home expenses, perhaps not a uniform, but internet, mobile, those are the sort of stuff. So it's substantially similar to that as if you were working an employed arrangement. So if that's the case, I would say it's probably not worth the money to go ahead and use an accounting software. But if you've gone and purchased equipment, if you've gone and let's just say you're a tradesman and you've gone and purchased equipment and you're incurring lots of costs and you want to think about expanding in time, those are reasons and contributing factors that might make you want to get an accounting software. It just comes down to complexity. So if there's a lot of moving parts, a software is much better. But if you don't have a lot of moving parts, Excel or a diary or some sort of other record keeping is fine.
Yeah, sure. We have a question around working from home expenses, and you touched on the fact that the rules have changed since prior financial years. What can still be claimed though? Can you still claim working from home deductions if you allocate it, I guess, probably to D5, it might be, to the other expense category? Are there ways to do it? Yeah.
Yeah. So the short answer is yes, you can still claim work from home deductions. They've just tightened the screws in terms of record keeping. So there's the actual cost method where you're actually taking the actual costs that you've incurred, you're applying the work percentage. So for example, the mobile phone, as a simple example, you would take the total number of calls and then you would take the work-related calls and then you would come to a percentage that's work-related, and then you would multiply that by your phone bill. And you would do that, perhaps with internet, maybe by an hours basis, total hours used, et cetera. Or you can use I think it's called the shortcut or the simple method, where you have a simple rate per hour. It's an all-encompassing rate per hour, which includes like your internet, your telephone, your occupancy, your running costs from working from home, which is electricity and utilities. So that's the easier way to do it. But again, there are record keeping requirements for that, such as diaries and logbooks and things to that effect. So what has changed? The rate has changed. What's included in the rate has changed. And also the record keeping requirements is the key one that's changed. And if I was a betting man, if there was to be a lot of deductible amounts in D5 that are higher than normal for your profession code, then perhaps you may get a review or please provide information from the ATO. So make sure you get across that. It's actually quite well documented on the ATO website, so you can go through the nitty-gritty detail and figure out. And they even have a calculator. So one of the other things the ATO does as well to help taxpayers is they often put an e-calculator. So you simply go on the website. So even if you type in Home Office expense calculator, it's step by step. You can just follow the calculator and work out what your deduction is, and then you can PDF that and save that as your evidence.
Yeah. Definitely. And another question that we've got is around the superannuation concessional contributions. Do you have any sort of further insights into what you can claim or not claim in relation to making those concessional contributions?
Yes, absolutely. So when it comes to concessional contributions, the concessional part of it, in simple terms, simply means that someone has claimed a tax deduction for it, versus the non-concessional where you've paid tax and you're putting in after-tax dollars into your super. So your SGC or super guarantee charge that your employer puts into your super, which in the current year is 11% of your salary, the employer would have claimed a tax deduction for it. So that forms part of your annual concessional contribution cap. So per year, so this year and also last few years, you can claim 27,500. So put simply, if you say for a high income earner and you earn $250,000 in the year, the 11% on top of that, I'm just going to keep it simple. We'll do round numbers. So let's just say 10%. It's about $25,000. And then so that means there's an unused portion in your current year of $2,500. But the ATO also has enabled, I believe from 2019 onwards, if you have unused concessional cap, you can actually carry it forward for a period of 5 years. So 5 years ago, if you only put in 10,000 and the limit was 25, there's 15,000 of unused that you can carry forward up to 5 years. So what that enables you to do is if you have say a big income year, which is an unusual income year, maybe you sold a property or something, you can actually put a bit of money into super. And you can usually go onto the MyGov website, or you can ask your accountant to generate an unused concessional contributions report, and that tells you how much is unused. Or if you want to, contact your super, your industry super fund, you can usually ask them how much have you made contributions-wise, concessional, over the last 5 years, and they'll give you that information. And then you can work out what the difference is. So yeah, absolutely, super is one of the most lucrative ways because essentially you're getting a tax deduction for a saving, because you're putting money into a concessional environment, which is a deferred saving mechanism for retirement. So yes, there's 15 cents in the dollar when it goes in, but relative to marginal tax rates, often you have a huge arbitrage there. So you get a tax deduction, and then you also defer that you've got savings for the future.
Yeah, I guess they try to encourage people to put money into that superannuation fund so it can grow over time until you can access it. And just one query around the Medicare levy surcharge and how that works. What did you just want to remind people sort of what the rules are around that, and what happens if you go above the income threshold? You'll then start paying.
Yeah, brilliant. Yeah. Brilliant. So I just want to articulate the distinction. So we have Medicare levy, which everybody pays. Mostly everybody pays, which is 2% on your income. So if you earn $100,000 in the year, $2,000 of that of your tax payable on that is Medicare levy. And then the next step above that is called the Medicare levy surcharge. So if you don't have adequate private hospital cover, you have to pay a Medicare levy surcharge. Depending on your income, it sort of is a sliding scale. And for singles, it's $90,000. So if you earn over $90,000 and you don't have private hospital cover, then you have to pay a surcharge. And for couples, it's $180,000. And for every child that you have, your limit goes up by $1,500. So for example, I've got 2 children. I'm married to my wife, so we're in a genuine domestic relationship. So our Medicare levy surcharge threshold would be $183,000. So $1,500 per child plus the $180 for a couple. So essentially, the reason that exists is the government wants to essentially have higher income earners either have their own level of health cover, so they're not reliant on the public system, or you make an additional contribution towards the public system because you are a higher income earner. So and they consider over 90,000 a higher income earner and 180 for a couple, which I think perhaps does need to get reviewed, but probably won't get done in a hurry.
Yeah. And Roger, if the person is preparing the tax return and they have a spouse as well, is it recommended to do it at the same time, or can they do it separately? I know there's sometimes questions asked in each person's tax return about the other spouse's sort of income arrangements.
Yep. So I believe the word is, are all of your dependents adequately covered by private health insurance? So if you're in the couple scenario, there is a requirement that, so each of you are each of your dependents. So you are both required to have adequate health, private hospital cover. So if simply you get it and the other person doesn't have the private health cover, then you aren't adequately covered. So yes, to answer your question, both of you should look to get it, only if it makes sense for you, because private health insurance can be quite expensive. The bare bones, but the way in which it's somewhat priced is the Medicare levy surcharge versus the bare bones package is somewhat comparable. So generally, most people, when they're doing their assessment on should I get it or should I not get it, is they sort of compare those two. Well, my surcharge is going to be X, but if I get it, it's going to be Y, and it's about the same, so I might as well get it. But some people also decide they just don't want to get it because they think they're young and healthy and they just pay the Medicare levy surcharge at tax time. Because the other thing with the private health insurance, you know, you get the monthly debit, it hits your bank account every month, versus something like your tax return in the future when it gets adjusted is in the future. So often people will also consider not getting it because they don't want to have to pay monthly.
Yeah. A question that we received is around negative gearing. I know that's probably in the sort of the property sense, but the person is querying whether is it really that beneficial to negatively gear, Roger, in your opinion, without going into too much of the detail, or do you say
that's a very big question. So just so that for everyone's benefit, negative gearing is when the income and expenses of a property are greater than the income generated from the property, and those expenses also include non-cash expenses such as depreciation. So if that is higher, then your property is negatively geared. If the income is higher than all of the expenses, including depreciation, then it's positively geared. So generally speaking, a negatively geared property is going to cost you out of pocket, generally speaking, right? So if it's going to cost you out of pocket, so then you need to work out, well, if I'm not getting a income gain out of the property on a year-on-year basis, and it's costing me out of my pocket, is that investment in the property that I'm paying for out of my pocket going to result in, say, capital gains down the track? So that's what you need to work out. And oftentimes, not oftentimes, it's case by case basis to be fair. But the longer you hold a property, the less it costs you out of pocket because you pay down the debt, which the biggest expense is usually the interest. And the longer you hold a property, generally speaking, you do see it go up in value as well. So you do get that capital gain, or your net wealth also goes up. So I can't comment on whether it's right or wrong for you. It comes down to your circumstances, but from historical sense, properties generally perform quite well in Australia. But that's not to say go ahead and buy a property. Just understand your own circumstances, and if you can afford to, absolutely go ahead.
Yeah, and Roger, we've got second last questions around the working from home deductions, and I guess this person probably has a room within their house which they've used to, for office purposes, and they've converted into that setting. How best do they actually apportion all the the utility costs, the lights, the running? It can be quite difficult to sort of apportion. Do you have any sort of quick tips around sort of benchmarking, I guess, how much you can apportion for electrical or phone, water, all that sort of thing?
Yep. If you do it properly, you actually have to go and have a look at the rate per kilowatt hour, and you have to look at how many hours you're working. It's actually very tedious, and in my view, it's actually not really worth going down to that level of detail to get, what often ends up being another $10 or $20 or $50. But there is ATO guidance on how to do it, and the ATO work from home calculator actually has all of those fields where you can put it in. So yes, you do have to go pull out your gas bill, look at the cost per hour, and enter that information in. So is there a quick way to do it? No, there isn't. And I think part of the reason that they've made it harder is they're trying to Mine is, well, according to Roger, is trying to disincentivize you from trying to do it the actual cost method and just simply use a rate, the set rate per hour. Because it's a lot easier to have that amalgamated rate where you just got to work out how many hours and then times it by the rate.
Yeah, it'll be. You can imagine someone going through their electricity bill and looking at all the tiered level of pricing and
Mate,
trying to figure out. It's never.
I can't think of anything worse, and I'm an accountant.
Yeah. And the final question is around you talked about all those deductions, right? And this person, I guess, is probably doing it online, and we've all done it. We've all gone through the ATO website and tried to put in all the fields and all that. And they've submitted their tax return. And in the future, if they think that they've made an error in terms of claiming less, are they able to go back and sort of rectify any old tax returns, or is it once it's done, it's set and forget, and you can't touch it anymore? And
yep, good question. So generally, as an individual taxpayer, you have up to 2 years from the date the notice of assessment is issued for you to go and make an amendment. And on the flip side, generally, provided you haven't had any tax avoidance issues, generally the ATO doesn't review a tax return, an individual tax return, 2 years after the notice of assessment is issued. So you have 2 years to fix it, and they've got 2 years to try and catch you if there is something that they think is an error. Unless it's blatant tax avoidance, and then there's an unlimited amendment period if it's actually tax avoidance. But 2 years is the number from the date you get the notice of assessment.
Great. Well, there you go. If you have made a genuine mistake and want to rectify, then you've got a window of time to do that. So that brings us to the end of this session and the Q&A. I'd like to thank Roger again for presenting his seminar. I think that was extremely thorough, and you went through a lot of information. So definitely everyone that's attended today will remember those top 5 tips and traps as they're preparing their FY23 return over the next 2 months if they haven't done so. And that brings us to the end of the session. I'd just like to thank everyone for attending today. Just a reminder, today's session is currently being recorded, and following today's session will be uploaded straight to our YouTube channel. And Roger has also prepared a one-page handout, which I'll email through to registered participants. Please do follow Be Informed on the social media channels that you can see on screen. We do rely on word of mouth and for you to share the experience that you've had. So we thank you for sharing Be Informed with your colleagues and friends and family. Our next session is on 13th of September. It'll cover art therapy in the health and wellbeing space. So we have a lot of interest in that session. So I'm looking forward to hearing from the presenter on that one. And that brings us to the end of the formalities. So again, thank you, Roger, for your time, and wish everyone a pleasant evening.
Thank you, Carl, and thank you for the attendees. Have a great evening.
Thank you. Bye for now.